Hey everyone, welcome back to Corporate Decoder, the place where we dig into the truth behind the numbers, and today we are sifting through Lesaka Technologies Incorporated latest quarterly report, and boy do they have some financial housekeeping to discuss. So Lesaka Technologies Incorporated is back with an amendment to their last quarterly report. Think of it as a revised edition with some important corrections. They have restated their financial statements for the quarter that ended the 30th of September 2024. The main reason for this update is an error related to how they accounted for revenue. Basically, they misclassified how they recorded income from selling certain vouchers, and this led to them understating both their revenue and their costs. This is a small detail, either it's about $8 million. They've also had to shuffle some numbers around regarding long-term borrowings because of a misclassification identified earlier this year. It's a reminder that even with all the checks and balances, sometimes mistakes slip through and companies have to go back and fix them. Looking at the balance sheet as of the 30th of September 2024, the company has total assets of about $551.9 million and total liabilities around $303.2 million, leaving them with shareholders' equity of almost $184.2 million. When we look at their assets, they have cash and cash equivalents of nearly $50 million. This is down from about $59 million in June. Their accounts receivable were around $30 million, and they also have finance loans receivable nearing $47 million. They also have a substantial amount of goodwill at over $146 million and intangible assets listed at more than $114 million. On the liability side, current liabilities stand at just over $109 million. This includes a current portion of long-term borrowings of about $16.4 million. Long-term borrowings themselves total over $132 million. Now let's talk about the income statement for the 3 months ending the 30th of September 2024 compared to the same time in 2023. Revenue saw an increase, bringing in over $153 million in 2024 compared to about $136 million in 2023. That is a solid 13% jump in US dollars. However, when you look at it in South African Rand, the revenue increase is closer to 9%. Their cost of goods sold, along with it processing, servicing, and support costs also went up to nearly $119 million versus about $107 million. This means their gross profit margin is getting squeezed a bit. Selling, general, and administration expenses went up to $26.7 million from $22.5 million. All in all, they reported an operating loss of $45,000 for the quarter, a flip from a slight operating profit of $228,000 in the previous year. Interestingly, they had transaction costs related to the Adumo acquisition, which definitely hit the bottom line. Ultimately, they ended up with a net loss attributable to them of about $4.5 million in 2024, compared to a net loss of $5.6 million in 2023. So, while revenues grew, profitability still took a hit. The big news on revenue is the restatement. As mentioned, for the 3 months ended the 30th of September 2024. After the correction, their reported revenue is $153.6 million. This is up from the originally reported $145.5 million. The restatement also adjusted their cost of goods sold, it processing, servicing, and support to $118.9 million, up from the original $110.9 million. Selling, general, and administration expenses also saw an increase up to $26.7 million from $22.5 million. This is about a 19% jump in US dollars or 14% in South African Rand. This increase is attributed to higher employee-related expenses, including bonuses and salary raises, more stock-based compensation charges, and increased consulting, legal, and travel expenses. Inflation also played a role here. These are costs directly tied to buying Adumo, totaling $1.7 million. These are one-time expenses, but they clearly impacted the company's operating income for this quarter. The company reported an operating loss of $45,000 for the third quarter of 2024. This is a shift from a small operating profit of $228,000 in the same period of 2023. This turn to a loss is largely due to the Adumo acquisition costs and increases in operating expenses. The bottom line is a net loss of $4.5 million for the 3 months ending the 30th of September 2024. This is an improvement from the $5.6 million net loss reported for the same period in 2023. So while they are still losing money, they are losing less money, which is a positive sign. Let S dive into the segments. The merchant division saw its revenue increase by 10% in US dollars, reaching over $133 million in South African Rand. This growth was about 6%. This division is really the engine of their business. The consumer division also showed growth, with revenue jumping 35% in US dollars to over $21 million. In Rand, this is a strong 30% increase. This segment is growing faster, but it is still much smaller than the merchant division. Now, they also talk about group adjusted EBITDA, which is a non-GAAP measure. It basically looks at operating profit before a bunch of other stuff like interest, taxes, depreciation, and amortization. For the third quarter of 2024, their group adjusted EBITDA was about $9.4 million. This is up about 17% from the prior year. This number is a good indicator of their core business profitability. Looking ahead, they mention their first quarter of fiscal 2025 results, where revenue increased by 13% in US dollars or 9% in Rand from the previous year. They attribute this to higher value-added services and processing fees in the merchant division, and increased transaction insurance and lending revenues in the consumer division. They also highlight a lower net interest charge due to lower borrowing rates, which is always good news. The merchant division revenue primarily increased due to higher volumes of value-added services, prepaid airtime sales, and processing fees. However, in Rand, the segment adjusted EBITDA for the merchant division actually saw a slight decrease. This is due to higher operating expenses, particularly employment-related costs, which were partially offset by higher gross margins. It's clear that the prepaid airtime business, while significant in revenue, has a low margin, which impacts this profitability metric. The consumer segment revenue boosted significantly thanks mainly to higher transaction fees from more Easy Pay Everywhere account holders, which is their transactional account product, and increased insurance premiums and lending revenues. This revenue growth directly translated into improved profitability for this segment, though it was partially offset by higher insurance claims and interest expenses to fund their lending book. Group costs also went up, which is typical as the company scales. These costs include things like employee-related expenses for group roles, Sarbanes-Oxley compliance costs, director fees, and audit fees. Now, let's talk about risks. The biggest new risk they've identified is the integration of the Adumo acquisition. They acknowledge that merging these businesses could be challenging, requiring significant attention from management, and potentially leading to difficulties in retaining key personnel. If they can't successfully integrate Adumo, it could result in material impairments and harm their financial health. They also continue to highlight their dependence on third-party suppliers for critical equipment like smart cards and devices, making them vulnerable to shortages and price fluctuations. Any disruption here could impact their ability to meet customer demand and slow down growth. Plus, they emphasize that not having a South African banking license means they rely on partnerships with banks like African Bank Limited for their Easy Pay Everywhere business. If these partnerships were to end, it could significantly disrupt their operations. The regulatory landscape in South Africa is also a concern, with potential changes to national payment system bills that could increase operating costs and require significant investment in new systems. This filing also reveals some significant internal control weaknesses. They identified material weaknesses in areas like their consumer lending process, payroll processes, annual goodwill impairment assessment, revenue recognition, and journal entry processes. Basically, there are concerns about risk assessment, monitoring, control design, and even a lack of experienced personnel to ensure financial reporting is accurate and timely. This led to the restatement of their financials, and they concluded their disclosure controls and procedures were not effective as of the 30th of September 2024. They are taking steps to fix these issues, but it will take time to ensure these controls are operating effectively. So, what does all this mean for Lesaka Technologies Incorporated? On the positive side, revenue is growing, particularly in the faster growing consumer segment, and their core merchant division is still showing increases. They are actively expanding their business through acquisitions like Adumo, which could offer significant growth opportunities. Their group adjusted EBITDA is also showing positive year-over-year improvement, indicating their core operations are generally becoming more profitable before those one-off expenses and accounting adjustments. However, those material weaknesses in internal controls are a serious red flag. The fact that they had to restate their financials due to revenue recognition errors and have identified multiple areas needing improvement suggests potential issues with financial discipline and accuracy. This can erode investor confidence and lead to higher costs for compliance and potential legal challenges. The integration of Adumo is also a significant undertaking with inherent risks. Looking at the numbers, the company is still not consistently profitable on a GAAP basis, reporting net losses. While the losses have decreased compared to last year, profitability remains a key challenge. The increased selling, general and administrative expenses and the ongoing transaction costs from acquisitions are weighing on their bottom line. For investors, the story here is one of growth ambitions coupled with significant operational challenges. The company is clearly pursuing an aggressive growth strategy through acquisitions and expansion, but they need to get their internal controls in order to ensure this growth is built on a solid foundation. The market will be watching closely to see if they can successfully integrate Adumo and remediate their control deficiencies. Alright, that is our breakdown of Lesaka Technologies Incorporated latest filing. What do you think about their growth strategy versus their internal control challenges? Let us know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more corporate dissections. Also, do not forget to join our Discord community linked in the description for more discussions. Thanks for watching, and we will see you on the next episode of Corporate Decoder.